Matt Maley, Tabak's chief market strategist. Matt, how significant would it be to get back 320 on the VIX? Clearly, it would allow a little bit more risk-taking. Walk us through the implications.
Well, I mean, it's kind of interesting because one of the things, if it gets there, you're right. It would allow some more risk taking and people to add a leverage to their portfolios. But we do need to be a little careful because when it has gotten down to that 20 level in the in the last year or so, it's usually a time where volatility picks back up. And to be honest with you, with the VIX down here, it also allows people to buy protection a little bit more cheaply if they want to do that. And with the S&P at an all-time high, but with that pretty decent divergence with the S&P 500, it's going to be hard for the stock market to rally a lot more unless that Nasdaq, the tech-heavy Nasdaq, sees a plays catch-up in a big way. Because even when the rest of the market is doing well, history tells us that if the tech group is doing poorly, the rest of the market has a tough time rallying and continuing to rally in a strong way.
Well, also what I find really interesting is that while VIX is declining, you have volatility within FX as well as Treasury market move higher. We started to see that weeks ago. Once we saw yields sort of inch their way higher, that's really picked up steam as we gotten over 1.5% on the 10-year. But is that sustainable? Because in theory, at some point, volatility in Treasury market should lead to some shift within asset classes, which should lead to more vol, right?
Exactly. I mean, it's one of the things where, a lot of people talk about, oh, geez, we don't have to worry about interest rates being, moving up because they're still very low on a historic basis. But if you look at the percentage move, I mean, it's got a 200% move in the long bond and in the yield on the long bond. And if you go back if you go back literally the last 40 years of the entire bull market for bonds since the early 1980s, we've had periods of time where stock prices and interest rates can move up in tandem, like we've seen in the really, over the last year or so. But at some point, when they get really extended, like this one's starting to be, this move in interest rates, it always leads to a hiccup in the stock market. That doesn't mean it has to be a big bear market, but we get corrections in most years, and therefore we're coming, I think, more vulnerable for a correction than a lot of people are realizing for the reasons that you just mentioned.
So where's that mark in the sand? Where's that line in the sand? We're just sub 1.6 at the moment. Feels like we've kind of stabilized after this big move higher, Matt, in terms of the 10-year. What does it take to get stocks unnerved? Because at the moment, we're seeing a kind of rotation within the equity markets towards the reopening trades. You're seeing the big airline stocks, the transport stocks doing really well on the back of that. How high does the 10-year need to go to start destabilizing the market?
Well, of course, it's always hard to know exactly what level that will be. I mean, it's funny how interest rates, came in. David Tepper talking about how he didn't say they would go down a lot. They just kind of said they'd stabilize, and that's what's happened. So the real line in the sand I'm going to be watching for is to see what level does the rise in interest rates cause the tech stocks, the Nasdaq, to roll back over and take out its recent lows, the lows from last week. If that happens, you see the Nasdaq or the NDX Nasdaq 100, either one, break below those recent lows. That's going to cause a problem for the whole market, and it'll probably be the catalyst will probably be a further rise in interest rates. So that's the real number I'm going to be looking at.
Yeah, it doesn't look like we're anywhere near that now, as we're back above now the 50-day moving average for the Nasdaq 100. So Bank of America Fund Manager Survey said that their investors were unambiguously bullish. If that's the case, where can you still be unambiguously bullish?
Well, I think the two areas, I mean, it's funny. A lot of people are really jumping on the bandwagon now in the bank stocks and the energy stocks and other commodity-related stocks. This is something that I turned bullish on commodities last summer. And then really in September, I started pounding the table on the energy stocks and the bank stocks. They're getting a little ahead of themselves in terms of just getting overbought on a short-term basis. Plus, we have to be a little careful because the dollar is rallying a little bit. And the thing is, even if they're unabashedly bullish, that's usually kind of a contrarian indicator. So we have to be careful about that. Yeah. But the point is, we don't have to be bullish 100% of the time. We don't have to be aggressive. I think those groups have worked really, really well the rest of this year, but buy them on weeklies rather than really chase them after these huge moves they've already seen since the fall.